on the one hand, I look at the rally today and you say, well, breadth is very positive. Credit markets are also participating. We obviously kind of broke above some levels that had contained the rallies right after Christmas. On the other hand, you have that tenet that the biggest rallies happen in bear markets. So how should we think about today's action in the context of the kind of trend we're in?
Yeah, I think the last point you made about the biggest rallies being in bear markets is the most important thing to remember now. If you get a couple days of strong rallies, we don't necessarily feel the need to chase them. In fact, on average, in a bear market, you have a 14% rally as the biggest rally. So this could even go on for a little while longer, and the primary trend could still be down. What we'd want to see instead would be sustained multiple days in a row of this kind of strong breadth action to say that the downtrend is over. So today's obviously a good sign, but it's too early to say that the worst is over.
What about the fundamentals here, Jim? Powell changing his tune, promising patience, the market sort of applauding that shift. Wasn't that a big risk factor?
Yeah, it was. December 18th, the market was 13% off its high. And then the next day was the Fed meeting when Powell said automatic pilot, and it fell to 20% off its high on wild volatility. And essentially today he took back automatic pilot, and guess what? We're now down 13%. So now we can go back to all the other issues that we had before the Fed, and that was the slowing global growth, potential political chaos, trade wars, and another one I'd throw in there too is earnings are slowing quite a bit. Fourth quarter is going to come in okay, but the first quarter's down to almost 3.5% growth, less than 5% growth for the second quarter. This is not what you want to see if we're going to resume a bull market, because we're getting down to almost the inflation rate now on the growth in earnings, and that could be a real problem going forward. So we got the Fed out of the way, but now we could go back to all the other things that got us down 13%, and they don't look like they're going to get resolved anytime soon.
Ed, Chairman Powell also mentioned 2016 as something that maybe resembled the current environment in terms of the Fed going on hold. We also had an earnings recession that year, and the markets, at least the way I look at it, had a somewhat similar setup in terms of negative sentiment and technicals and things like that. How would you read that comparison at this point?
Well, I think it is a fairly appropriate one. Of course, the market doesn't repeat itself. It does rhyme, so it's not going to be a perfect comparison. But you did get a 13% rally in late 15, and then you plunged to the bear market lows in February of 2016 with an earnings recession along the way. But you didn't have an economic recession in the U.S. And so when you don't have an economic recession, declines tend to be around 20 to 25% peak to trough. So again, that's another analogy to think that maybe there's a little bit more to go on the downside. But as we go forward over the next few months, as Jim said, we're going to have to go through some pretty tough downside earnings revisions. But if those get stopped, where we say we have, mildly negative earnings or even mildly positive earnings, and then we can pick up from there, the market should start to price in better news as we move into the second, maybe third quarter.